Are you ready to build, grow, and protect your investments? Welcome to the Index Investing Show, where we give you the tips, tools, and philosophy for reaching your financial goals. And now, your host, inventor of the Portfolio Report Card and author, Ron DeLegge.
All right, coming up on today's program, a real-life lesson in perseverance. And it's a good habit that all of us should cultivate. We're going to talk about that on the show. Also, question on gold miners versus gold. We're going to get into that, as well as what's going on the Twitter feed, as well as financial markets globally. So stay tuned for that. 844-305-7800 is the number if you'd like to join us. We're here. Do give us your first name along with your city. If there's a specific ticker symbol that you want us to discuss, ETF, individual stock, mutual fund, closed-end fund, we can do that. Again, 844-305-7800 is the number, and we're here. You can also tweet the program live at Index Show. That is where you find us there. So let's take a look at market action quickly. Thus far, since the beginning of 2019, we've got all major asset classes in positive territory, being led by stocks. We've got U.S. stocks as tracked by the Schwab Total U.S. Broad Market ETF ahead by just over 17% since the start of the year. SCHB is the ticker symbol on that one. International emerging market stocks also up in double digits between 13 to 15%. So we've got global stocks rallying. We've got commodities also up just a nudge over 5.5%. USCI tracks that area. And then global real estate also doing well, ahead by 16%, REET. Total U.S. bond market is a laggard. It is up, but it is lagging the other major asset classes, BND, ahead by about 2.5% thus far this year. So we're going to take a look at what some of the key industry sectors and the ETFs tracking them are doing coming up a little bit later. In terms of market sentiment, market mood, what are the readings saying right now, aside from the performance that we just described, which has been very strong bullishly? If we take a look at the Fear Greed Index, which measures really the market's mood, the sentiment, is it fearful? Is it jittery? Is it happy? Is it exuberant? And right now, remember, 0 is extreme fear, 100 is extreme greed. We're at 74. So just for perspective, 1 year ago, we were at 22, which was an extreme fear reading. Now we're at 74. We've been really, for the past month, the past week, we have been in the greed territory. And so that just gives you kind of an idea and understanding of where we're at in terms of market sentiment. I think it was the great Warren Buffett who said, when others are greedy, I'm fearful, and vice versa, right? So right now, there's, according to the market readings, a lot of greed. And this takes a look at multiple indicators: stock market breadth, market momentum, market volatility, which has been depressed for all of 2019, as well as put and call options. So that's just a reading, just a heads up to help you understand where we're at. A contrarian alert, right? Because we like to, at times, do the opposite of the crowd. Now, it's not always a winning formula in the short run, doing the opposite of the crowd, being a contrarian, but time has proven that to be a very successful strategy over the long run. It does pay off. But again, it's not always a winning strategy in the short run. Some of those trades that are contrarian, some of those investments are puke-worthy. And in fact, I think it was one of the great traders who said that when asked which trades should I put on right now, he recommended to do the trade that makes you puke. In other words, the one that you don't think is going to make you any money. because that's probably the right move. It gets back to investing being very counterintuitive. And besides being counterintuitive, it's important for all of us to cultivate the right investment habits, the right things, the right behavior, the right type of conduct that leads to results. We'll do a little bit later on today's show a real life lesson in perseverance. One of the most amazing lessons in this particular habit that I've ever seen. And interestingly, it was not done by a famous person. I like to typically extract examples that show not just the habit, but the habit in practice. The person who best emulates that particular habit. We often select famous investors, well-known investors. Well, they're not always necessarily the greatest examples of that habit. Sometimes it's anonymous investors, people who are not famous, people who are not well-known, that emulate these legendary habits. And so we're going to talk a little bit about perseverance a little bit later on the program and give you a real-life lesson. I'm really looking forward to that. 844-305-7800 is the number. We're here if you'd like to join us. If you want to talk about any particular stocks, mutual funds, ETFs, if you want to talk about a particular investment strategy or your financial plan, we can do that. Again, 844-305-7800. At Index Show is my Twitter handle. Tax deadline here in the U.S. is coming up. It reminds me of Will Rogers. He had this to say about taxes. The only difference between death and taxes is that death doesn't get worse every time Congress meets. That's pretty true. That is absolutely true. In reality, I've seen a number of studies out there that say that the tax changes or tax rule changes as of 2017, what's become known as the Tax Acts Jobs Cuts Act, it has reduced temporarily the tax bill for most Americans by about $100 on average. So taxes, for the most part, will be under control. It shouldn't be any higher for most Americans in 2019 than it was before. But where are taxes heading? We've talked about this before on the show. We're not going to really get into it today, but when we look at the history of U.S. income tax rates in the U.S., where we are today versus where we've been in the past and where we're heading, I mean, you can't but see that we are at really historical lows in terms of U.S. income tax rates, and the future, after this current tax rule and tax law expires in 2025, it's going to be a whole different ballgame. And so your financial planning, your retirement plan should take that into account, especially if you plan on being alive past 2025. Now, if you plan on being dead before 2025, then it really doesn't matter. Okay? You don't have to worry about it. But if you're planning to be alive beyond 2025, then absolutely yes. Your retirement plan should address the very likely reality that we will have substantially higher taxes in this country. And so your retirement plan should directly address that. As you know already, we are big-time proponents of tax-free investing. If you can make your investments tax-free, things like Roth 401k, Roth IRA, Roth conversions. Now, what do I mean by tax-free? Well, obviously you have to pay taxes along the way to get into the tax-free zone. But once you pay them, you're done. And that's what tax-free investing is all about. But at any rate, I thought I'd share that particular quote with you from the great Will Rogers. It's a good one. Well, it's almost time for us to take a quick break. When we come back, we're going to talk about real lessons in perseverance, a good habit for all of us to cultivate. Also, question on gold miners versus gold. We're going to take a look at these two particular strategies versus each other and compare them with each other. I'm Ron DeLegge. This is the Index Investing Show. More when we return. Go nowhere.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
All right, we often talk about the importance of having three what we call buckets or containers when it comes to constructing an investment portfolio. So those three buckets, I like to simplify it and just think about it in terms of your serious money, your play money, and your safe money. Okay? So your serious money is your core. That's your foundation. That's where the bulk of your assets will be invested. It should be fully diversified across the 5 major asset classes, low-cost index ETFs that are proxies for the asset classes that they're tracking. That's your core, okay? That's your serious money. Your play money can be anything else. It could be individual stocks. It could be long, short strategies. You could be cryptocurrency, options, hedge funds, actively managed mutual funds, whatever crazy things come to your head, that's your play money. That's where you're trying to obviously make money and add to the overall wealth of your overall portfolio, the kitty. But your play money can sometimes work out and sometimes it won't, right? That's why we call it play money. And then you've got your safe money. That's your what we call margin of safety. That's the portion of your portfolio that's earmarked for 100% capital protection, zero, or what we call principal protection, zero volatility, and guaranteed income. That's your safe money. So each one of these components complements the other. It does not do the same thing. This is the framework that I teach in my online classes that are available at indexshow.com. Go there, click on classes, and enroll. And this is the framework that we teach you for building, growing, and protecting your money. Now, the reason I mention this is because there is a company, a private company that recently went bankrupt called Munchery. Munchery, like food, like munching. Actors Jared Leto, Marissa Tomei were among the celebrities who were equity investors in Munchery when the meal delivery business went bankrupt in February, according to newly filed records. Other notable names listed as Munchery shareholders include Olivia Munn, Hill Harper, Adrian Grenier. These are according to, again, recently released documents. What is the context for investing in privately held startups, companies that are maybe venture capital funded, maybe funded by angel investments, angel investors? What is the context? Does anybody know? Can anybody help me figure this out in the context of those three containers? Serious money, play money, safe money. Where do you think something like investing in a company that's private, like Munchery or a startup or whatever it is, an app, where do you think that falls within the DeLegge framework? Does it fall under serious money, safe money, or play money? 844-305-7800. You tell me where you think that falls. And again, it's okay to lose money on an investment if it's in the proper if that investment is kept in its proper context, and as long as you understand that. It's not okay to lose money on an investment if it's taken out of context, if it's in the wrong container. So tell me where you think, again, an investment like this, a privately held company that is angel or venture funded, what do you think that goes within the framework of portfolio construction? Is it serious money, play money, or safe money? 844-305-7800. You can also tweet your answers to @IndexShow. I want to mention this real quick before we give you some performance numbers on what's happening in industry sectors, because there's a lot of good things happening for sector investors. But before I get into that, I know that some of the folks listening to the show are behind in their retirement savings. They got started late or they haven't started yet, and there's many, many reasons for that. Maybe a crisis, maybe a divorce, maybe whatever, a health issue. A recent study by Allianz Life Insurance Company found that nearly half of individuals between ages 45 to 65 surveyed consider themselves to be retirement chasers. These are people who are saving for retirement but have either fallen behind on where they should be, wish they could accumulate savings faster, or worry if they don't boost savings soon that it's going to be too late to have a comfortable retirement. So if you find yourself in this situation, I just want to give you a quick tip. There's a rule called the 20-30-50 rule. Again, that's the 20-30-50 rule. How does it work? It helps retirement chasers by having them take 20% off the top of their savings, 30% for variable expenses, and 50% for fixed expenses. So that's the 20-30-50 rule. Start thinking about whatever you're bringing in, segregating that money into 20-30-50. 20% off the top for savings that gets put away automatically, 30% for variable expenses, and then 50% for fixed expenses. And then also rethink your risk tolerance. You need to balance your appetite for loss relative to the risk for gaining whatever return you're trying to get so that you can retire on time. Often what I see with a lot of retirement chasers, as we call them, or I like to call them retirement late savers, is that they will increase risk in order to compensate for the fact that they're behind. And so their thought is, well, listen, if I'm going to increase risk, that's going to also increase the likelihood that I'll make more money. Well, not always necessarily true. Especially as you get closer to your target retirement date, you should not necessarily be taking more risk. You should be taking less risk, especially if you're behind. It could even put you even further behind if you encounter a market climate that that becomes unfavorable or doesn't cooperate. That could really set you behind even further. So again, just some tips on what you can do strategy-wise if you find yourself in this situation of being a retirement late saver. I also have an online class that I built specifically for people in this situation where they haven't started yet saving for retirement, or they got started late, or they're behind. So go to indexshow.com, click on classes, and you can enroll in that particular course. 844-305-7800 is the number. We're here. You're listening to the Index Investing Show, and if you'd like to join us. Now, we're going to talk about a real life lesson in perseverance coming up a little bit later. We talk about the necessity for developing and implementing and cultivating good habits that lead to financial outcomes that are positive. This is what we want for you, but it doesn't happen by accident. It happens by taking deliberate steps to make that happen. And so to do that, you have to have the right habits. So we're going to talk a little bit later about a real life example of this particular quality or habit that I think is just so remarkable. And you're going to really, really enjoy it, so stay tuned for that. Let's take a quick gander at what's going on industry sector-wise. We already told you what's happening with the broader asset classes throughout the globe. When we say asset class, by the way, those of you wondering what that means, all we're talking about is a basic type of investment. So an asset, for example, like equities or stocks, that's an asset class. Fixed income or bonds, that's another type of asset class. Commodities, that's another asset class. So this is the context. But when we talk about performance, we looked at it broadly. We're going to look at it coming up next from a industry sector perspective, because there's a lot of good things happening sector-wise, and I need to bring you up to speed on the sector ETFs and what's happening there. So stay tuned for that. I'm Rhonda Legge. At Index Show is where you find me on Twitter, and I'll be right back.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
First, the basic idea. Working people defer the money they earn. Next, that money can be used in the future to pay for basic living expenses, so long as it's wisely invested. To acquire these skills, tune in to the Index Investing Show with Ron DeLegge, a carefully designed program for working people who save and invest money. The Index Investing Show is now available at iTunes, Spotify, YouTube, and other world-class platforms.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
All right, so taking a look at industry sector performance thus far in 2019, it's been really a good year in terms of all 11 S&P 500 industry sectors. Now, all of them are up, but some are up more than others, and I'm going to give you the leaders. Ticker symbol XLK, which follows the technology sector, is number one, ahead by almost 25%. XLK has been a star performer. XLI, which tracks industrial stocks, ahead by almost 21%. This particular ETF, ticker symbol XLI, tracks this area, industrials. It's got 70 stocks within it, and the top three holdings are Boeing, 3M, Union Pacific Corp. So those are the leaders in terms of what's been driving XLI's performance higher. You saw that name Boeing in there. Yeah, that's the number one holding in XLI. And despite of all the issues that Boeing is facing with one of its jetliners, it continues to perform quite well, along with the entire industrials sector. XLY tracks consumer discretionary stocks, and this particular ETF, XLY, is ahead by almost 20% since the start of the year. Now, some of the top 10 holdings in XLY are, well, I'm just going to give you the top three. Amazon.com, Home Depot, and McDonald's. Those are the top three in XLY. That particular ETF, by the way, consumer discretionary, holds 64 stocks. It represents almost 11% of the overall S&P 500's industry or exposure, rather. So that's consumer discretionary. And that, by the way, is the less defensive industry sector consumer-wise. Of course, the more defensive one is consumer staples. One other industry sector I want to tell you about is financials, which this past week gained significantly. It was driven by shares in J.P. Morgan Chase, which jumped almost 6%. The bank reported first quarter earnings per share and revenue that beat analyst expectations. The CEO, Jamie Dimon, said that even despite global geopolitical uncertainty, that they continue to see economic growth and employment and wages rising. Inflation is moderate. So that, of course, was good for the financial sector. That's ticker symbol XLF, which in its own right is doing pretty good. It's up 14.5% since the start of the year. And so there you have it in terms of industry sector performance. Now, a couple of industry sector ETFs that use leverage that have done even better, well, because they're using leverage, right? They're magnifying performance gains. That's their objective or goal. TECL, which is the Direction Daily Technology Bull, 3X shares, that has been a star performer. It's up over 82% since the start of the year. TECL, and then DUSL, which aims for triple daily performance to industrial stocks, ahead by just over 70%. So those two ETFs for your play money, for your non-core portfolio, that's the proper context for those types of investments. And for you traders that have been bullish on those two sectors, you've done quite well. One other one is real estate, which we reported earlier has been a top performing asset class. DRN aims for triple daily performance to real estate stocks, or also known as REITs, ahead by almost 57% since the start of the year. So you can see where leverage works. It works quite well when the trend or momentum is strong in a certain direction. That's when it's best to use leverage, if you're going to use leverage. And that's the proper context for using it. And so that can help you hopefully stay out of trouble. I would not use a triple or even double daily leveraged ETF in a market that's neutral or in a market that is going the opposite direction that I'm trading. I just think it's crazy. So anyway, that's what's going on there performance-wise. 844-305-7800 is the number. At Index Show is my Twitter handle. Speaking of Twitter, let's see what's going on there on our Twitter feed. CNBC had a piece about ice cream that costs $1,500, and it's the most expensive ice cream in America. Wow, that's amazing. It's you can buy it at the Baccarat Hotel in New York, which I've been to. It's quite opulent place. I've also been to the Baccarat in Paris, by the way. The Crystal, I think it's called the Crystal Room, which I think is even more opulent. Both are great, but $1,500 for ice cream. Here's my thought on that. The investing fees that nobody pays attention to, located in the prospectus that nobody reads, pays for stuff like this. $1,500 ice cream. Of course, you're not eating the ice cream. Somebody else is. Also, a retweet by Jason Zweig at the Wall Street Journal. A recent study from Fidelity Investments purports to show that active funds outperform passive. Of course, it only works if you don't count all the funds, right? You just segregate the ones that you want to count and you exclude the ones you don't want to count. Listen, I haven't gotten into these debates of active versus passive for quite some time because to me it's not really a debate. Indexing in the long run wins, and if you're going to invest in active funds, I'm not going to tell you not to. Just do it within the context of your play money. That's your non-core portfolio. If you own active funds, that's the proper setting for those types of investments. And of course, your serious money, which is the bulk of where your assets will be, should be indexed. It's that simple. Also, another retweet from Bloomberg Opinion. When companies ditched pensions and 401k plans, they put the burden of saving for retirement on their employees. Yeah, no duh. Well, the Pension Destruction Act of 2006, which nobody remembers, is a contributing factor to poverty in retirement. Yep, that's right. The Pension Destruction Act of 2006, which was allegedly supposed to save pensions. It really did the opposite, that legislation. But that has also been a contributing factor. Also, another retweet here from our program from last week. We did a portfolio report card. We analyzed a $322,000 inherited IRA, and you can listen to that. We, by the way, archive every single radio broadcast that we do. It's available on podcast. You can listen at Spotify, iTunes, as well as Google Play, and our website, indexshow.com. 844-305-7800 is the number. We're going to, after we take a quick break, we're going to get into this question about gold miners versus gold. We're also going to take a real-life look, or a hard look at a real-life lesson of perseverance, and a good habit that all of us should cultivate if we want to achieve a positive outcome with our investments. So stay tuned for that. 844-305-7800 is the number. It appears that nobody knows the answer to the question that I asked earlier. If you're going to invest in startups, if you're going to invest in venture capital, angel investing, companies that are new, unestablished, and trying to change the world, what is the proper context for that type of investment? Which container does it go into? Does it go into A, your serious money bucket? Does it go into B, your play money bucket? Or does it go into C, your safe money bucket? Does anybody know the answer to this question? Hard. It should be pretty obvious. 844-305-7800 is the number. If you know the answer, call the show. You can also tweet the program at Index Show. And I'm going to give away a signed copy of my book, Gents with No Sense, to the listener that can answer this question correctly. Very important. I'm Ron DeLegge. This is the Index Investing Show. When we come back, perseverance. Learn it.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
All right, want to read this email. Dear Ron, you talked about selling covered calls on gold ETFs. Can I do the same strategy on gold miner ETFs? Signed, Dean in El Paso, Texas. Well, first of all, the difference between gold versus gold miners, I mean, for those of us not familiar with this, gold, of course, is a physical asset, right? It's an asset that has no dividends, generates no income, and the reason you buy it is because you hope it'll go up in price, right? More than the price that you paid for it. Gold miners, in contrast, are actual companies, or also known as what we call stocks or equities. And so when you buy a gold miner stock or ETF, you're investing in not gold itself, but you're investing in companies that mine gold or distribute gold or produce gold. So those are gold miners. Obviously, though, the two are closely linked in terms of their correlation to each other. So, I mean, if we take a look, for example, at gold miners versus gold just this year, if we look at GDX, which is one ETF that tracks gold miners, and we compare it to the price of gold, they're almost identical in performance over, not so much over short periods of time, but over longer periods of time. You'll see a high correlation in the performance. For example, over the past year, GDX has gone down just about 1%. GLD has gone down about 3.5%. So pretty close performance. It's, of course, does at times veer or diverge from each other. But you can absolutely sell covered calls on gold miners ETFs, Dean, as long as that ETF that you own or have selected has options, calls, and puts traded on it. This strategy, by the way, generally works best with ETFs that have a lot of trading volume because that will, for the most part, translate into good trading volume for the calls or the put options. So the thing, too, that the example that I used that Dean is talking about with the selling covered calls on gold ETFs, I deliberately chose gold ETFs because I wanted to show the audience that it is possible with exchange-traded funds to take an asset like gold, a dead asset, that, again, generates no income, has no dividend yield. It just sits there. And you can take an asset like gold and you can actually turn it into an asset that generates money every month. And you can do that by selling covered calls. It's just one of the many strategies that ETFs give you that kind of flexibility, and why we're such fans of ETFs over even index mutual funds, which don't give you that type of flexibility or choice. Now, if you're going to sell covered calls, obviously that's not what we would consider a core investment strategy. It would go into your non-core investment portfolio or container. That's where your play money goes. 844-305-7800 is the number. We're here if you'd like to join us to talk about anything on your mind. Follow us on Twitter at Index Show. You can also check out my online classes, indexshow.com. Click on Enroll, and you can check out the 4 different classes that I teach online. There's not enough time on the program to cover everything, but you will find something in those online classes that helps you to improve your results and also help you have a better understanding of your investment process. Those of you that do not yet have a written investment policy statement or plan should have one. And if you don't have one and you're a do-it-yourself investor, you're managing your own money, well, then you need to get one. And the class that I teach called Build, Grow, and Protect Your Money, a step-by-step guide, in that particular class, you will get a template investment policy statement or plan that you can just use for yourself. Adapt it into your own plan, fill in the bits and pieces like your asset allocation, your diversification, and there's some other things mentioned in there. But these are the things that your investment plan should cover. It should be written out so that template you can use in your own plan. And of course, that's something I think that's crucial to your success. Now, I want to talk about something that we discussed at the outset of the program. We discussed mentioned a real life lesson in perseverance, a good habit that all of us should be cultivating. Now, to preserve as an investor requires time. Yet the time that we all have is I think the one commodity that's in supply. Once time is lost, it can never be regained. Now, that's a lot different than money, right? If you lose money, it can be regained. If you lose time, it cannot be regained. Even if you have unlimited resources, you cannot buy more time. And so as a result, investing, when we look at it from the context of investing, we can make time work for us in a few different ways. First, what way can we make it work is by focusing your time and your efforts on high payoff activities. So instead of spending time on unprofitable ventures with zero hope, you allocate your attention to the opportunities, investments or business-wise, that offer the highest profits and the best chance of success. Second, and this ties into persevering, you need to allow time for your investments to grow. It's just like a garden, right? You plant a garden, you spread the seeds, you water it, you give it the right soil. It's not going to grow tomorrow or even next week. It takes time to blossom. And this is especially the case when we've got short-term shocks in financial markets that happen. What the person that has perseverance does is, instead of selling those assets when they're down in price, they persevere. Time is your friend, impulse is your enemy. Now, the habit of perseverance, I think, is best emulated by somebody that you've never heard of, an anonymous investing great by the name of Ronald Read from Brattleboro, Vermont. Now, despite earning a humble salary as a janitor, he quietly amassed an $8 million fortune. $8 million! Now, how did he do it? It wasn't by gambling his earnings on lottery tickets, nor was it by day trading. Rather, it was by buying quality companies, hanging on to them through thick and thin, good times and bad. And after his death in 2014, Ronald Read's family, they were shocked to learn about his hidden wealth. He left $8 million behind. This is a man that was a janitor. And before that, he worked as a gas station attendant. Nothing wrong with those types of jobs, but they're not typically associated with millionaires, multimillionaires. The Wall Street Journal reported that he owned at least 95 stocks at the time of his death, many of which had been held for years, even for decades. Among Read's portfolio, holdings in venerable companies like Johnson & Johnson, Dow Chemical, J.P. Morgan Chase, Procter & Gamble, and CVS Health. Read's extraordinary performance results, of course, were not always positive or wonderful. Let's not forget that. They weren't always positive or wonderful every single year. He, like many others, suffered through various economic recessions, including the 2008 financial crisis, the implosion of the dot-com bubble in 2000. But what was the difference? It was Read's habitual practice of persevering that ultimately led to his mind-boggling results. There you have it. Perseverance. Cultivate it. That does it for another episode of the Index Investing Show. Join us again next week. We'll be here.
Thank you for listening to the Index Investing Show with Ron DeLegge. Connect with us on the web at indexshow.com. And be sure to subscribe to our podcast at iTunes, Spotify, or Google Play.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.